All right, hope you guys had a great weekend. Thank you for coming back. I was talking with some people here about the Chiefs. I went to Kansas City Chiefs NFL game. They didn't do very good. But has anybody ever gone and sat in a suite where they have food and drink? Yeah. Has anybody ever done that? Mm-hmm. It's wonderful, is it not?
It's awesome.
If you don't watch the game.
I was like, is there a game going on out there? I'm convinced I could watch people reconcile their checkbooks. And if I'm in a suite with leather chairs and free food and drink, it will be a very, very enjoyable experience. So if you've never done that, I recommend it. It was great. So, all right, let's go over the homework, okay? Before we go over the homework, though, let me state something real important to the folks at home. Not so much my online folks, but the people who are watching this on YouTube, who are not one of my students. I said last time that if you want the handouts for this class, to email me as opposed to leaving a YouTube comment. I do look at the YouTube comments, but I prefer not people. Sometimes people will leave a YouTube comment that says, "Hey Dave, can I have the handouts?" It's like, I don't know how to get them to you. You just left your name. Even if you leave your email address, what I would prefer you do is send me an email. And they put up my email address all the time during this. And send me an email and ask for the handouts. And here's what's important that I didn't state last time for you folks who watch it on YouTube. Ask me for the Accounting 2 handouts, or you might get the wrong set of handouts, okay? So ask me for the Accounting 2 handouts. And one last thing, tell me where you're from. I love to hear where people are from. And a lot of times I'll get up my Google map and see where you're from. And don't just say I'm from Africa. Africa is a big continent, okay? Be more specific than that. It's fun to hear where you all are from. So if you need the handouts, please state specifically you want the Accounting 2 handouts, okay? Re-email me if you didn't state that stuff in your previous email from last lecture. All right, how was the homework?
Good.
Not too bad? Okay, let's go over it. The first thing I want to go over is the textbook homework. And I believe I assigned Quick Study 12.1, Exercise 12.1 and 12.4. Okay, let's go through that. All right. Quick Study 12.1, okay? Amy and Lester are partners in operating a store. Without consulting Amy, Lester enters into a contract to purchase merchandise for the store. Amy contends that she did not authorize the order and refuses to pay for it. The vendor sues the partners for the contract price of the merchandise. Okay, the first question they're going to ask us is, must the partnership pay for the merchandise? What'd you guys get?
Yes.
Yeah.
Yes. And why is that?
Each partner is authorized to do business for the business.
Exactly. Each partner is authorized to conduct business for the partnership. And what do we call that concept?
Mutual agency.
Mutual agency. Very good. Okay, very good. Now, it has to be reasonable business for that. Now, they operate a store, so buying merchandise, I think, is a reasonable expenditure for a store. Would you agree? Now, let's look at B. Does your answer differ if Amy and Lester are partners in the public accounting firm? Yes. And I would say yes. Why would you say yes, Daniel?
Well, because they don't both own the company, and they're just employees in the company.
Well, no, they're still partners. They're partners in the public accounting firm, but maybe what you were saying is buying merchandise if you're partners in operating a store makes sense, right?
But you're going to have different customers and everything else.
But if you're partners in a public accounting firm, though, buying merchandise doesn't make as much sense. Let's use a different example, a better one than the book. Remember when I was saying you guys were partners in a landscaping firm? Well, it would make sense if Daniel went and purchased stuff at the grass pad as far as grass seed and some fertilizer, because it's a landscaping firm, right? And he can obligate the partnership, the landscaping firm, for that. But let's say he went to Best Buy and bought a 76-inch TV and, you know, that's not really a reasonable expenditure for a landscaping business. So he can't go buy that big old TV and say, hey, I can do this for the partnership. That's not a reasonable expenditure for a landscaping business. Now, granted, there might be some gray areas and it needs to be interpreted by an arbitrator or a judge. But the main thing that they're trying to state here is, as mutual agents, partners can conduct business without all the other partners being there. They can conduct business on behalf of the partnership if it's reasonable. And in this case, buying merchandise, you remember merchandise inventory, right? Buying stuff to sell, that makes sense if you're a store, if you're operating a store as a partnership, but if you're operating a public accounting firm, well, they don't sell merchandise. See what I'm saying? That's kind of what they're getting at here. Okay? All right. Questions?
Sounds like a trick question.
It's not so much a trick question. We like to think of them as questions that make you think a little bit. Okay? So I think it could have been clearer as far as the type of business. Like I think my landscaping business example clears it up a little bit. I should write a textbook. Okay? I'll get right on that. Let's take a look at exercise 12.1. All right? Now exercise 12.1 says, next to the following list of 8 characteristics of business organizations, enter a brief description of each characteristic as it applies to general partnerships. And they give us these different characteristics, and they want us to state the application. Now, this is one of those questions that you might think, I'm not really sure what they're asking here, okay? And if you didn't put these exact words, that's fine. The main reason I want you to do a problem like this for homework is that when you're studying for your test, it'll be a good refresher as far as the type of business it is and the characteristics of it. So let's take a look at it. Okay, the life of a partnership is limited. We talked about that, right? A partner dies, that partnership is over. The owner's liability is unlimited. And I know we discussed that as well, right? Okay. The legal status, it is not separate from the partners. It is not a separate legal entity. It is a separate business entity, but it is not a separate legal entity. Okay? What about the tax status? Partners are only taxed once, and it's at the individual level. The partnership itself is not taxed. Cool? The owner's authority, and we talked about the concept of mutual agency, but that's a good example. You might be thinking, I'm not sure what they're asking here. Okay? What they're getting at is the mutual agency concept. The ease of formation, it requires only an agreement. And it's really pretty easy to start a partnership. You don't even have to have a formal partnership agreement. Okay? Transferability of ownership. It is more difficult to transfer, okay, because you have to have mutual consent from the other partners if you want to sell your partnership to somebody else. Okay, so it's not as easy as like we'll find in Chapter 13 with a corporation and selling stock if it's publicly listed. Now, the ability to raise large amounts of capital is pretty low. Michael and Daniel, if you have a partnership and you want to raise a couple $1 million, well, unless you have a rich grandma or something, it's going to be pretty difficult, right? Okay, questions on that? All right, then let's go to exercise 12.4. Exercise 12.4 states, Angela Moss and Autumn Barber organize a partnership on January the 1st. Moss's initial net investment is $75,000, consisting of cash of $17,500, equipment of $82,500, and a note payable reflecting a bank loan for the new business of $25,000. Barber's initial investment is cash of $31,250. These amounts are the values agreed on by both partners. Prepare journal entries to record the initial investment for each one of those partners. Okay, let's go ahead and do that, all right? I don't think this is too difficult, is it? Let's take a look at what those would look like. All right, let's show the initial investment first for Moss. Moss, oops, wrong way. Moss puts in cash of $17,500, equipment of $82,500. There's a note payable attached to the equipment of $25,000, And so I always list everything that is going into it and then just ask, well, what do we need to do to balance out this JE? Well, we need to credit or increase Moss's capital for 75. Would you agree? Okay. All right. Next thing is Barber put in cash of $31,250, correct? So that's a pretty easy one. You debit cash, you credit capital for $31,250. All right? Okay, cool. Questions?
That's supposed to take 25 minutes.
Well, yeah, hopefully it didn't take 25 minutes. I don't know where they come up with those estimates. People always ask me that. But sometimes they're high and sometimes they're low. Okay? I also wanted you to finish the Lucinda and Donna handout. Is that correct? All right, let's go ahead and do that. Let's go ahead and do that. By the way, if you didn't do your homework and you're just kind of watching me do it, you know well enough from taking Accounting 1 that you're not going to learn this stuff, right? You got to do your homework. You can't just watch me do it and go, oh, I see what he's doing, okay? That gives you a deceptive or a sense of a security that's kind of deceptive, okay? All right, Lucinda and Donna handout. If net income is $42,000, prepare the journal entry to allocate income between the two partners, assuming the partnership agreement states that net income should be divided 1/3 for Lucinda, 2/3 for Donna. Okay? Well, we have a net income, so we're going to be debiting income summary to close it out, correct? And we're going to credit capital for Linda for how much? 1/3 of 42,000, which is 14 grand. And then we're going to credit capital for Donna for 2/3 of 42,000, which is $28,000. Not too bad, is it? Okay. Any questions there? Now this is all going back to, just a little refresher, remember the closing process. Remember when we learned this in Accounting 1? We close the revenues to income summary. We close the expenses to income summary. And then we have a net income situation here of 40,000, right? Revenues are 100, expenses are 60. But with the partnership, there's more than one capital account. So you have to know how much to put in each blank to increase their capital if it's a net income. Remember, capital is a credit balance account, right? All righty, let's do the next one. Different scenario. If net income is $42,000, prepare the journal entry to allocate net income between the two partners, assuming that the partnership agreement states that income should be divided based on initial capital contributed. Okay? Now, you have to go back to our original, do you remember what the original capital balances were when we did this top part? Do you remember that when we did this top part of the worksheet from last lecture? Okay. I believe, correct me if I'm wrong, let's look at the capital balances. I believe the capital balances for Lucinda and for Donna from those journal entries on A and B on this worksheet were 7,680 and 16,320. Is that correct? Okay, if we add those up, that adds up to 24,000, correct? Now, let's figure out the allocation. 7,680 divided by 24,000 is 32%, correct? 16,320 divided by 24,000 is 68%. And of course, that needs to add up to 100%. And there might be times you have to round a little here. It's fine. Then what do we take that times? The net income of 42,000. Is that right? And if we multiply that, 32% of 42,000, if I do that in my head, I think that's about 13,440. 68% of 42,000 is, what is that, 28,560. Is that correct? And of course, that needs to add up to what? And it needs to add up exactly, right? Because the journal entry we're going to make, let me just make it above. The journal entry we're going to make is, we're going to debit, thank you, income summary of 42,000, right?
Yes.
And we're going to credit capital accounts for Lucinda and Donna for 13,440 and 28,560. Correct? So there is our journal entry. Do you agree?
Yes.
All right. Good deal. Okay. Questions on that? Any questions on that? Okay. We have another one too, don't we? That was the Mike and Scott example. Or was it Scott and Mike? Scott and Mike. All right. Same thing. Let's take a look at that one. All right. At the beginning of 2014, Scott has a capital balance of 60,000 and Mike has a capital balance of 90,000. Okay? The partnership of Scott and Mike earned a total net income of 100,000 in 2014. Prepare the one journal entry to allocate net income between the two partners if they've agreed on the following. Okay, there are salary allowances of 50,000 and 30,500 respectively. There's a 1% interest allowance paid on each partner's beginning capital balance, and the remainder will be shared equally. Correct? So let's do this little process that we go through. Now, 100,000 is the net income. Is that correct? Okay, now let's list out our salary allowances. Our salary allowances for Scott and Mike, respectively, are 50,000 and 30,500. Is that correct? Yes. All right. Then we have interest allowances. Now, interest allowances, it states that will be 1% of the interest, 1% paid on the beginning capital balances for each partner. And they tell us those, don't they?
60 and 90.
Those are 60 and 90. So what's 1% of 60,000? 600. What's 1% of 90,000 for Mike? 900?
Yep.
Okay. Now let's add these four numbers up, and that equals 82,000. Oops, 82,000, not 82,100. 82,000 exactly, right? Are we good? We good?
Yes.
Okay. What's 82,000 subtracted from 100?
18,000
18,000. And how do we divide that up?
equally.
Balance is divided equally. What's half of 18,000?
9,000.
9,000. Add up these numbers. These three numbers add up to 59,600. These add up to 40,400. Is that right? So if you wanted to do the journal entry, that would be debiting income summary for 100,000 and crediting or increasing capital for Scott, capital for Mike for 59,600 and 40,400 respectively. Does that plus that equal that? It needs to, doesn't it? Because otherwise your journal entry won't balance. Now remember, we're not distributing cash here. We're crediting capital. Okay? If they choose to withdraw on that in the future, that's their decision. Does that make sense? All right, any questions on that top part? Okay, now we're going to do the whole thing again, and we're only going to change one aspect of it. And that is the net income is instead $145,000.
So on that, could you just add 45,000 to the 18 and then split that in half?
That's
Instead of redoing all of that?
yeah, maybe you would, but I've been doing this for 20 years. I still redo the whole thing. Whenever I do a shortcut in life, I always figure out I should have just done it. Anybody else have those situations?
No.
Whenever I try to make a shortcut in accounting, I always end up messing it up. So I would go ahead and just real quick, what are the salary allowances? 50,000 and 30,500. What are the interest allowances? 600 and 900. So you are right, Jeremiah, in stating that all of this stays the same, correct?
Yeah.
The total of those numbers is still 82,000. If we take 145,000 minus 82,000, we get 63,000. And and then we're going to divide that balance equally. What's half of 63,000? 31,500. Add those up, and I believe that is 82,100 and 62,900. Does that plus that equal that? Yes, it does. So our journal entry would be to debit income summary for 145,000 to close it out. And we're going to increase the capital accounts for Scott and Mike respectively for 82,100 and 62,900. Does our journal entry balance? Yep. Does the total debits equal the total credits? Yes. Okay? You guys get that? Not too bad, is it? Great. All right, any questions on any of that? You online students, I'm not there to make sure you're doing your accounting homework. So you have to be disciplined, okay? You have to be disciplined. Make sure you're doing that homework, okay? All right. What I want to do now is we're going to actually finish the lecture to Chapter 12. Chapter 12 is not a real long chapter. And what I want to talk about now is, I'll tell you when I get there. First of all, I want to look at an example of partnership financial statements. Remember how I stated that each partner has a capital account and each partner has a withdrawal account with a partnership? Well, when you look at the statement of equity for a partnership, it looks very similar to maybe a statement of changes in owner's equity for a sole proprietorship, except that there's a column for each partner. In this example on the screen, there's two partners. There's two columns, one for Smith, one for Jones. Shows their beginning balance, shows it increasing with their share of net income, shows it decreasing with their share of withdrawals, so shows their ending capital balance. Okay? Very similar. Just a column for each partner. Cool? All right, now let's talk about admission of a new partner. Admission of a new partner. Now, there might be times, like let's say that Michael and Daniel want to bring on another partner to their business for whatever reason. Okay? Well, when the makeup of the partnership changes, the former partnership is dissolved. Okay? They're going to enter into a new partnership. And it can be immediate. Now, there's two ways that we're going to learn that a new partner can come on board. They're going to come on board either by purchasing it from the other partners or by investing assets into the partnership. Okay? Number one is really, really easy. Number two, that's a little more difficult, but that's not bad. Okay? Let's talk about this. What about the admission of a new partner by the purchase of partnership interest? Well, a new partner can purchase partnership interest directly from an existing partner. And in this case, the cash is not being invested into the company. The cash goes to the partner selling their interest, not to the partnership. And of course, there needs to be consent by the other partners to do this. Now, all of these are going to be best learned by looking through an example and then in a couple of minutes doing an example. Okay? Let's take a look. On January 2, Jones agrees to sell Newbie $10,000 of her partnership interest for $25,000 cash. The other existing partners agree with this arrangement. Okay. Let's say that before this occurred, there's capital balances for Smith and Jones of $108.5 and $65.5. Okay, so there's total capital balances of $174 before this takes place. Now what's going to happen is Jones is going to give up $10,000 of their capital balance to Newbie, who's going to have that. Now they're going to sell, he or she is selling this to Newbie for $25,000 cash. The capital balances after this new partner comes on board are shown there at the bottom. Now what does this journal entry look like? The journal entry looks like this. Now again, I hope you know your account balances. This all makes more sense if you do. Capital is a what? A normal debit or a normal credit balance account? Credit. It's a credit. So here the credit, we are crediting capital for Newbie for the $10,000, and we are decreasing capital for Jones, decreasing it by debiting it for $10,000, just as it shows in that chart above. You with me? Now, that's the only journal entry. What about that $25,000 cash that's exchanged? We do not make a journal entry for that. That's on the personal level. It's outside of the business entity of the partnership. Does that make sense? That's pretty easy, isn't it? Okay?
So is that $10,000 probably worth a lot? Well, it's worth a lot more than $10,000.
Perhaps. Perhaps. But again, just because a capital balance of $25,000 is $25,000 doesn't necessarily mean it's worth $25,000, right? Okay? There's a lot of other market factors that come into play here. Okay, so it's hard to make a grand statement that says they got a really good deal here or something, okay? There are some businesses, there are some partnerships that are so poorly run and in such a poor market, and they have a poor product where a capital balance may not mean as much, okay? All right, what I want to do now is I want to work on a handout. This one will be really quick. We'll probably only give you about a minute to do it, okay? But I want to do this handout here. If you don't have this, when they start playing the music, I'll give you one, but I think most of you have it. I want you to do example 1 on the chapter 12, excuse me. On the chapter 12 handout called Mission of a New Partner, go ahead and do example number 1 while they play the music. All right? Okay, play the music. We'll be back in just a minute. get to the album. Okay. Let's go ahead and take a look at this. Hopefully this is pretty easy. On January 2, Staubach agrees to sell Dorset $28,000 of his partnership interest for $22,000 cash. This personal transaction between partners, but the other existing partners of Pearson and Dupree agree with this arrangement. Prepare the journal entry for this transaction. Okay, we decrease one capital balance and increase another capital balance. Whose is being debited or decreased? Staubach. And whose is being increased or credited?
Dorset.
Dorset, okay. And how much is this for? Is this for 28 or 22,000? 28,000. The $22,000 cash exchange is between the partners themselves. It's not within the partnership entity. So that's it. That's all we have to do. Pretty easy, eh? Okay. Questions? Now let's take a look at the second way of bringing a new partner on board. The new partner can also gain partnership interest by contributing assets to the partnership. Okay, that's kind of usually how they start. You know, when at the inception of a partnership, there's assets put in. Okay, the new assets will increase the partnership's net assets, won't they? And thus, equity will increase as well. Because we can remember from Accounting 1 that an owner contributing assets into the business increases capital or equity. Correct? All right, now there's three potential scenarios when a new partner buys in. There could be a no bonus to anybody. That's when the current value of the new assets is equal to the new partner and their amount of capital. Okay? It could be a situation where there's a bonus to the old partners. That might be a situation where, coming off the screen real quick, Daniel and Michael, let's say that you guys are going to, you have an existing partnership and you've been at this for 3 or 4 years, and you're going to bring on Jeremiah. Well, what you're going to see is in that scenario, when there's a bonus paid to the old partners, you guys are going to be compensated for your 3 or 4 years of blood, sweat, and tears that you put into this business, right? I mean, you guys have been at it. He can't just come on board now that all the dust is settled, right? So in that sort of scenario, you might have a bonus to the old partners. Okay?
So would that be like off the books, or would that be on?
It'll be on the books, and I'll show you here in a second. There could be a situation also where there is a bonus paid to the new partner. Okay? Can you envision a situation where it makes sense for a bonus to be paid, or not, I don't want to say paid, when there's a bonus given to the new partner? Let me give you a scenario. Michael, Daniel, let's say you have your partnership and you guys are struggling a little bit in your landscaping business. You want to bring Jeremiah on. Jeremiah is an expert landscaper, okay? He's an expert landscaper. So in this sort of situation, he might come on board, but in essence, he's going to have to be given a bonus for coming on board because of the level of his expertise. Does that make sense? So there are scenarios where it would make sense both ways in regards to the bonus. This is going to be best learned by doing examples, okay? So let's take a look at an example. First of all, let's say there's no bonus to anybody. On January 2, Smith & Jones agreed to accept Newbie as a partner upon his investment of $30,000 cash into the partnership. Okay, the capital balances before the new partner are listed on the top line. Newbie is going to invest $30,000 cash into the partnership, and that's also going to be how much Newbie's capital balance increases. Okay? So you can see the capital balances after the new partner. In this case where there's no bonus, this looks a lot like the initial capital investments by the partners. The cash is debited or increased for 30 grand. The capital for Newbie is increased or credited for 30,000. You with me? Okay, pretty easy. What if there's a bonus to the old partners? Now let's look through this methodology here. On January 2, Smith & Jones agreed to accept Newbie as a partnership upon his investment of $60,000 cash into the partnership. Newbie is going to receive a 20% ownership interest in the new partnership. Any bonus is attributable to the existing partners and is shared equally. Let's walk through this. All right. Okay. The beginning equity of Smith & Jones is 174, as we can see from previous slides. Okay? How much assets are going to be input into this partnership? There's going to be 60,000 of assets put in, right? So that's going to be total partnership equity of 234 when it's all said and done, after that infusion of another asset of 60 grand cash. What ownership percent are they giving newbie? 20%. What's 20% times 234,000? 46.8. So let's build this journal entry. Cash is going to be increased by 60,000. Newbie's capital balance is going to be increased or credited by 46.8. So there is the first part of the journal entry. Okay. Now, do the debits need to equal the credits? Yes. Actually, in accounting too, that's not important. On journal entries, the debits. I'm just kidding. I'm just kidding. Journal entries always have to balance. Okay. Freaked you out a little. Okay. Total debits have to equal total credits. Always, always. So we debit or increase cash for 60,000. We credit capital newbie for 46.8. Now that doesn't balance, does it? How much help does it need to balance? It needs 13,200. Well, how do you think we're going to divide that 13.2 between?
Split it in half.
We're going to split it in half. It's not always equal. It's not always equally balanced or divided, but in this case it is. So you divide that 13.2 by 2, and Smith's and Jones' capital are both increased by 6,600. This is in essence how they receive their bonus. There's not a cash paid to them, okay, but their capital is increased by being credited. Does that make sense?
So they basically own more of the business.
They basically have larger capital balances by bringing on this partner, okay?
Where does the 13,200 come from? Is that 20% of the total?
No, that is just that journal entry that you're looking at on the screen.
Yeah.
That doesn't balance, does it? Well, what do we need to do to make that journal entry balance? The credit side needs 13,200 worth of help. Does that make sense?
Well, I get that part. Just how'd they decide on that number?
On what number?
Like how'd they decide he'd get 46,800 for 60,000?
Well, it goes back to this right here. They're putting in cash of 60,000. They agreed that they're going to invest 60,000, and they're only giving them 20% interest. That was just what they decided on. So 20% of 234,000, which will be the total partnership equity, is 46.8.
That's what I was wondering.
Does that make sense? So Jeremiah, going back to what you were saying, in essence, they're receiving a bonus because their capital accounts are increasing. The old partners' capital accounts are increasing, and they didn't have to infuse any new capital, any new assets in themselves. You with me?
Yeah.
Good. That's a bonus to the old partners. Now, notice that this balance, again, is shared equally. It's not always shared equally. It might be 2/3, 1/3, or 20%, 80%, or whatever. You have to make sure to see how you divide up that 13.2. In this case, it was equal. What about a bonus to the new partner? Same methodology, folks. Smith & Jones agree to accept newbie as a partnership, again, upon their investment of 60,000 cash into the partnership. But this time, newbie is going to receive a 30% ownership interest. And any bonus attributable to the new partner is going to be adjusted equally. Let's go through the same analysis. The beginning capital balances are 174 for Smith & Jones. 60,000 cash of assets is going to be put in by newbie, so that'll bring total partnership equity to 234. But this time, newbie's percentage is going to be what? 30%. What's 30% of 234,000? It's 70,200. Well, let's list what we know in the journal entry. Cash for the partnership is being debited or increased by 60,000. Capital for newbie is being increased or credited for 70,200. Does that journal entry balance? No. How much help does it need to balance? 10,200. How do you think we're going to divide that in this situation? Equally. So in a way, their capital, well, not in a way, Smith & Jones, the original partner's capital is being decreased. So that's the way that the new partner is getting paid a bonus. Okay? They're in essence giving that part of their capital to newbie. Okay? Make sense? All right, folks. Let me talk about a couple of slides real quickly, and then we're going to work on something in class. The withdrawal of a partner. We're not going to do journal entries for the withdrawal of a partner, but suffice it to say, it can happen in two ways, and it's pretty much the flip-flop of what you just learned. It could kind of occur off the books, where there's cash exchanged and you just adjust the capital balances. Or there can be a withdrawal of assets by the withdrawing partner. Okay, so we're not going to really do journal entries on that. We're not going to really do journal entries on the liquidation of a partnership. But let's at least talk through the steps on the liquidation of a partnership. If a partnership decides to call it quits and dissolve, here's what they do. First of all, they sell all their non-cash assets, their equipment, their supplies, their vehicles, their automobiles. Okay? If there's receivables, they collect on those. If there's any gain or loss on those fixed asset sales, they allocate that based on their partnership agreement. Now, there's still no cash distributed on step number 1 and step number 2. Okay, they're just allocating those gains and losses to those capital balances. Number 3, they pay off their liabilities. And then finally, any remaining cash that the partnership has is distributed to the partners based on their capital balances. Cool? All right, what I want to do now in class is, with the time remaining, is I want you to work on part A and part B of example number 2 with the Dykstra partnership. If you get done, you can go ahead and start on this bonus question. That'll probably be part of your homework. But let's go ahead and work on part A and part B of example 2, Dykstra partnership. All right? I'll give you some time to do that. Okay, if you folks at home are not done, then just pause and start us up when you are done. But I want to make sure we have a chance to go through this answer for A and B. All right, you have a partnership here. The total partnership equity originally is $200,000, okay? Any bonus or paid to or by the partners is equal. Tom Lito is admitted to the partnership and given a 30% interest in equity and a 30% share in income and loss. Okay, here is the situation that we're dealing with. The original equity of the old partners is $200,000. In situation A, Lito is going to invest cash of $50,000. So after that $50,000 cash investment, total partnership equity will be $250,000, correct? All right, so what's the Lito ownership percentage going to be given? 30%. What's 30% of $250,000? It's $75,000. So let's put what we know. How much is cash going to increase by in this journal entry?
50,000.
How much is capital for the new partner of Lito going to increase by?
75,000.
That doesn't balance, does it? No. Which side needs help?
Debit.
Okay. The debit side. It needs 25,000, and how is that going to be divided? What were the original partners' names? Hulse and Morris. Okay. So that's capital for Hulse, capital for Morris of 12,500. Is that correct? Okay. Any questions on that? Any questions? Okay. Let's do situation B. In this instance, what if the cash investment is $90,000? Okay, well, let's go ahead and do this real quick. The equity of the old partners is still what, $200,000? Can you see that? How much cash is coming in by the new partner? $90,000. So the new total partnership equity in total will be $290,000. What's the ownership percentage for Lito?
30.
What's 30% times 290,000?
87,000.
87,000. So let's put what we know, okay? Capital for the new partner of Lito is going to increase by 87,000. Cash is going to be debited or increased for the partnership of how much?
90,000.
Okay, does that journal entry balance? No. Which side needs help?
Credit.
The credit side needs 3,000 help in total. How's that going to be divided?
Equally.
Equally.
Apiece.
Okay, so let's look at this in closing. In the first situation, was a bonus paid to the old partners or to the new partners?
New.
The new partners.
No, the new, I mean, yeah.
Because the old partners' capital balances are being debited or decreased. In the situation B, is there a bonus being given to, I don't want to say paid because it makes it sound like they're getting cash out. So let me state that again. In situation A bonus is given to the new partner. The capital balances are being decreased for the old partners. In situation B or part B, the bonus is for the old partners because their capital balances are being credited or increased without their having to put in any new assets themselves. Does that make sense? Okay. So what I want you to do for homework is I want you to finish this. I want you to do this bonus question, okay? Bonus question. Do that and also do exercise 12.5, 12.6, 12.9, and 12.7. So the bonus question on this handout and those 4 exercises. Okay, folks? Hey, have a great day. We'll see you guys later. Make sure you're doing your homework, all right? Also, one last thing before they turn off. You folks at home that are taking this class online, make sure you are looking at your due dates for Chapter 12 Connect at this point. because as soon as we are really done with chapter, well, we're not quite done with chapter 12. Actually, that'll be after the next class period. But always make sure you are looking at your due dates on Connect and test due dates. It's on the red calendar section of the D2L website, guys. Always be aware of that. Put those on your smartphones. See ya.